and welcome to the Vanilla Times. Today we have a very special guest on our show as we'll be talking to Mr. James de Castro. Hello James, it's a pleasure to have you with us today, and an honor. You've been a veteran and a successful derivatives trader, first in London and then in Asia. You've seen the vicissitudes of life as it exists in these high-octane derivative markets. Can you please tell us about your experience during the roller coaster decades of the 1990s and the 2000s? You know, the ups and downs, so to say.
Well, it's a pleasure to be here. It certainly has been an interesting time being in Asia all of this time and in the derivatives markets. I started out in Bankers Trust straight out of university, and I did really a rather combined course, crash course as it were, where I was introduced to interest rates, currencies, equities and commodity derivatives all at the same time. If you recall, the early 90s were when the beginning of the collapse of Japan, when everybody still believed that Japan was going to be what we would not call, I guess, the next China. It was going to dominate the world, and the Nikkei would carry on rising forever. And in fact, in '89, which is when I joined, we had the peak of the Nikkei on the 31st of December. We have never seen that high to this day. We had a tremendous amount of activity with Nikkei derivatives at that point in time. We then had the Gulf War, and I was also, strangely enough, in the front lines of that because I was assisting the commodity derivatives desk on a couple of gold deals, and then suddenly it had to be all hands on deck because we had this big war going on, and commodity derivatives suddenly exploded. We had I think we had maybe 12 times the amount of business in that particular year than we had later. Or before. I then changed to equity derivatives very briefly and ended up leaving Bankers Trust and joining Merrill Lynch. When I joined Merrill Lynch, I moved to Tokyo, and I was there from '93 to '96. I ended up running the Nikkei derivatives book. Really very much over the decline of Japan. Japan ever since then has spent its time sort of going down, up a little bit, down, up a little bit, down, up a little bit. But there's been obviously a huge amount of work in derivatives around them. It's been a combination of Nikkei put deals, many various types of convertible and exchangeable securities, and warrants, of course. Also the Swiss-Japanese warrant market that is nowhere near as active nowadays. I then moved to Asia at a time when everything was really centered around the Hong Kong warrant market. It was a market that was developing, extremely active, but from a complexity point of view, it was actually quite simple. It was mainly call and put warrants. One of the most successful ones we did was when the trader we had at the time, Andy Kleinguti, predicted that Hong Kong Bank would quickly rise above 100, and we issued a warrant with a strike around that level. And he was very quickly proven right with all of the euphoria around the handover. We then had, obviously, the collapse after the handover, the Asian crisis, SARS, and certainly a large number of ups and downs of all kinds. Throughout all of that, there has been an enormous expansion in the complexity and the range of the derivatives being offered in the market. What started out as being very plain vanilla with warrants and buy rights ultimately evolved into a plethora of products that had highly elaborate correlation risks. And in my point of view, towards the end, they really, by the time I left Merrill in 2007, they reached a point where people were gilding the lily a little bit too much. The complexity of the products had reached a point where it took me several hours to understand the risk of one of these products. And I was doing this with the benefit of a degree in physics and decades in derivatives. So I questioned whether all of those products, or indeed most of those products, were properly suitable for retail without a very extensive education program. And I'm now beginning to see that the regulators are moving somewhat towards that direction. There is an increasing emphasis on investor education, on suitability, and on issues of this type that I think are entirely appropriate, because the classic tests of I guess investor sophistication that existed in the legislation, that centered mainly on net worth, are not exactly suitable when anybody in Hong Kong who owns an apartment would be a sophisticated investor by the previous legal definition. And we've seen a fair amount of regulatory emphasis on going for something bigger than that, and I think it's probably appropriate and timely, and I don't see that going away in any time soon. We then, of course, had the global financial crisis, That has changed a whole bunch of things in how derivatives used to work. One of the things that was happening before was that we had, and this has been true really all the way from when I started in Bankers Trust until I left at Merrill, that you work in a big financial institution, you had essentially, not quite an infinite, but you had an essentially infinite balance sheet available to you by merely calling the finance desk. And if you needed to do a position that was 10 times bigger than what you had before, as long as you had the risk limits, borrowing was never a problem. When I talk to my colleagues who are still in the industry, the situation has radically changed. Even in institutions that are as financially sound as UBS and some of the other Swiss banks, for something as simple as a single currency, people will have possibly 10 different yield curves, depending on exactly what it is that they intend to do in a particular transaction. Whether it's asset-backed, what kind of asset is backed, what kind of counterparty, how long they're going to hold it for, exactly what structure is being held in. So you can no longer price all derivatives off the same curve. And it actually reminds me to something that I was taught very early on when I was extremely junior by one of my mentors at the time. It was a fellow called Phil Borg, in whose debt I forever remain. And one of the things that he told me was that all of these tricks that we learn with our various arbitrages in derivatives are certainly very useful. But in time, every single one of them gets arbitraged away, and you need to work quite hard to catch the next one. The sophistication increases, the amount of brain power you need to develop, to deploy, to capture it also increases, and the returns diminish. And it gets, ultimately, you're definitely in a diminishing returns type of situation. And what he told me at the time, which I still remember, is that the one thing that you can count on to always stay ahead of the game is a careful study of regulation, because the regulator has yet to be born that will write a fully consistent set of rules for anything. There are a number of reasons for this. One of them is that the people with a greater degree of sophistication in derivatives tend to work in the industry rather than in the regulators. But second, and probably more valid and actually most durable reason for this fact, is the fact that the regulators are not profit maximizing entities. The utility function, as it were, is not very clearly defined, because they have many different calls upon their attention. You have a crisis at some point, you have malfeasance at some other point, you can have all sorts of different political pressures trying to drive the force of regulation forward, and it's never guaranteed that these things will actually be consistent with each other. So as a result of that, the regulation reflects it. Regulations are hardly ever internally consistent.
Your specialty was equity derivatives. Today, equity derivatives as an asset class or a product class seems to have fallen off the cliff. Why and how did that come about?
I think it ties down to a number of the things that I was mentioning earlier. The first one is that complexity got a little bit ahead of itself, and that is now being tamed partly by pullbacks on the banks themselves and partly by regulatory action. The second one is that under the increasingly stringent capital rules that banks are having, equities are more heavily penalized than, for example, certain debt instruments. And as a result of that, the balance sheet constraints on the banks are themselves proving to be more complicated. And the third one, which is related to the first one, is the fact that the investor education requirements and similar sort of know your client and suitability requirements are also putting a little bit of a damper on the whole thing. A contributory factor early on was the fact that the equity markets themselves were not in great health. But obviously that is becoming less of a concern at the moment.
You worked on some of the path-breaking financial products while you were a trader and a quant. Can you tell us a bit about your experience?
It really has been quite interesting. I've been sort of fortunate and lucky to be around when some quite exciting things were happening. Where I was at Bankers Trust at really very much the birth of equity derivatives in an institution. On an institutional level, and we also did quite a few interesting things in those days, even with currency options. We were doing some of the first barrier options, some of the first look-back options, some of the first Asian options, and it was a very interesting environment to work and a very fast-paced one compared to nowadays, because, for example, we were able to speak to a customer, come up with an idea for a new product in the morning, model it over lunch, and trade it in the afternoon, and book it, not even in Excel in those days, because we didn't have an Excel. We would book it in Lotus 1230 or Lotus Symphony, and somehow it all worked. So that was very, very exciting. I then had when I came to Asia, the path-breaking aspect of doing these things came out in a different dimension. It wasn't so much the complexity of the structures, but the complexity of the regulation and the underlying. So in many cases, you had situations like markets, for example, that could have a split foreign and local listing, and you had to deal with the fact that the same underlying could have two prices. And that was a different sort of complexity that isn't really readily addressed by something like Black-Scholes or the diffusion equation, because it would require an extremely schizophrenic version of it for that to really work. We've also had other schizophrenic versions of regulation from some of the countries in the region, and I don't really want to name names, but suffice it to say that we've had a couple of exciting interruptions in what was otherwise really a reasonably smooth progression. Another area that was very interesting for me was commodity derivatives during the first Gulf War. And the reason for that is that in most financial assets, you have a very clear friend that allows you to price almost all derivatives with time. And that friend is the forward curve. And the forward curve is driven only by the cost of carry, the yield on your money relative to the yield on the underlying. In the case of something like oil, that no longer works, because oil doesn't have a yield of any kind. And oil on one particular month is not the same as oil 6 months later, because if you put it in a tank and take it out of the tank 6 months later, bacteria might have eaten it. So in fact, realistically, the easiest way to store oil is to not get it out of the ground in the first place. That problem becomes even more acute with refined products than it is with oil, because they're more subject to faster bacterial degradation very often. When I was when I first started trading commodity derivatives, then we had to work out how to account for the fact that the forward curve is really more of a correlation type of relationship, and there are limits that you can draw to how much difference there can be between the price of 1 month and another in one direction, but not necessarily in the other one. The problem is asymmetric. If the price of oil 1 month away was too high, you could certainly take oil today, put it in a tank and store it, although the cost of storing it was complicated by the fact that you needed to deal with the possibility of fire, insurance, regulation, stuff like that, but it was theoretically possible. The arbitrage, however, doesn't work the other way around, because if, for example, it is winter in New York and you need heating oil, you need heating oil today, and the fact that heating oil next month is cheap doesn't work, because you don't have a time machine to transport heating oil next month into heating oil this month so that you can put it in your heater and not be cold in winter. So the arbitrage is extremely one-sided. The result of that was that for most of my career at that point, the oil forward curve had a very funny shape most of the time. It was basically like this. The front was up, then it went down, and then it rose again. The market now is different, and I have a feeling that the influx of financial players and the increasing sophistication of the producers has led to the establishment of something that is closer to a proper forward curve. But I still think that it is very vulnerable to sudden shocks, and backwardation can reassert itself with a vengeance very rapidly the moment there are serious problems with supply.
In the mid-1990s, when the derivatives markets imploded and fell into disrepute, many then said that the financial derivatives are dead. But the markets continued on. New products came in, great innovation in the derivative space took place. Some of it quite stunning, like cookie and volatility products and credit derivatives. And life became even better. Do you think that with the financial crisis of 2008 and with all these regulatory constraints on sell-side banks, the evolutionary forces of the markets have finally been stopped in their tracks? Or will the markets and products morph into something new and better once again, and the evolutionary process will continue on?
It's an interesting question. I think there has certainly been a secular change. Throughout my entire career in derivatives, I have seen all of the changes and all of the ups and downs of the markets as being fundamentally cyclical. You could always count on the fact that there is a cycle. The cycle might be up one day, it might be down the next day, but the cycle is coming back. I believe that we have now entered a structural change where the relative weight of finance in the economic system is diminishing on a sustained basis for some time, and it will take quite some time before that trend reverses. It doesn't, however, mean that the derivatives markets are not coming back. It just means that the emphasis on the products is quite likely going to change. I think it's going to have to be driven by paying closer attention to regulation. I think products that require access to large amounts of balance sheet at arbitrary single prices will no longer work. But it does not mean that innovation is dead. It just means that innovation will have to move in a different direction.
You have a degree in physics from the University of Oxford. Has physics come in handy in your work as a trader or quant? I mean, does having a degree in physics, math, or engineering give a person a better or perhaps a wider perspective on the discipline of quantitative finance?
I have found that certainly at the beginning when I started, it gave me a tremendous advantage because in those days, people in economics and people studying economics or coming out of business schools had very little background in quantitative finance. We did not yet have the Nobel Prize for the Black-Scholes model, and it simply did not have the same profile. And as a result of that, they were very poorly trained from a mathematical point of view. So from that point of view, if you came in with a physics background and you understood something as simple as the heat diffusion equation, when you looked at Black-Scholes, life seemed very simple because it's a single variable problem. It's no different to the heat equation, and it was extremely trivial, really. The only other dimension of finance was interest, and that's no more complicated than e to the minus rt, which again to a physicist is trivial. You could write the Black-Scholes equation in one line as an integral, and the results of it made sense. So as a result of that, he definitely had an enormous advantage over people who were burdened by a different mode of thinking coming out of economics and business. That has changed to some extent right now because the people coming out of the economics and business schools are better prepared in quantitative finance. But I nevertheless think that a strong technical education is a distinct advantage because you have much more familiarity with statistics, much more familiarity with differential equations, much more familiarity with integrals, and much more familiarity generally with the fact that whatever you're dealing with, you have some amorphous sort of form of a distribution about where some asset is going to end up. You have a clearly defined payoff function, and ultimately all you really need to do is find some way of integrating that payoff function. In the easier cases, the integration is analytic. In the more complicated cases, it has to be numerical. But fundamentally, you're still solving variations of the diffusion equation.
The landscape of quantitative finance is rapidly changing. Where is it headed? There are a lot of physics, math, and engineering graduates for whom working in a sales and trading role or quant role within a sell-side investment is a dream come true. What do you have to say to them?
I think some of the changes are good, and some of the changes are not necessarily quite so bullish for people entering the industry right now. In a sense, I had it quite lucky because I entered when I was getting started, and I got out of it at what felt at that time like a cyclical peak, but in fact may have turned out to be a structural one. Most of the easy gains in innovation, most of the low-hanging fruit has already been picked by people like me and my predecessors. So it's going to be harder. However, it can still be extremely rewarding. From an intellectual point of view, the complexity of the products is quite intriguing. The modeling skills needed are quite interesting. The applications of many of the derivatives products, particularly in the hedging side, to the real world are unquestionable. On the investment product side, the biggest challenge right now is how to make sure that the products remain relevant to the needs of investors and remain inside what an increasingly stringent regulatory regime is likely to permit. So I think the challenges are actually going to return to what I was referring earlier from my old mentor Phil Borg. I think they're going to return towards a careful study of regulation. So while when I started out it was enough to be very good on a quantitative subject, I think at this point in time you need to be very good at a quantitative subject. In fact, probably better than people were when I started. I have a feeling that the people I have hired through the years have been smarter than me. But you also need to be good on the regulatory side to make sure that you're able to function in an environment that is going to grow back towards increased regulation.
Over the past decade, you've hired a lot of fresh graduates from management institutes in Asia to work for your team and your bank as structurers, traders, and quants. Today, what skills in a young graduate are crucial for success within a sales and trading role in an investment bank?
I think the skills remain the same. You need to be quantitatively very strong. You need to be hardworking. You need to be extremely curious, because without curiosity, nobody's going to sit down and teach you. You need to be very much a self-starter, very much able to find things out for yourself. And then you also need to develop an awareness outside of the purely technical subjects to be able to spread into regulation and to understanding why things work and what the needs of the client are. In the early days, it was often enough to have a clear understanding of what if you want, the stochastic process of the asset. But nowadays, even on the trading side, you also need to have a clear idea of what the client wants and what the regulatory wants and how big the market is. On the structuring and on the sales side, obviously those needs are even greater.
Thank you very much, James, for sharing your time and experiences with us.
Thank you very much. It's been a pleasure, and I hope it's useful to many of the CFE candidates. I've had a wonderful time in the markets over the years, and I'm definitely delighted to be able to share my experiences with other people.
Thank you for watching this episode of the Vanilla Times. Please subscribe to our channel on YouTube for upcoming videos of the Vanilla Times. Thank you for watching and stay tuned.